Hi everyone, I am Pallav Goel, an associate in the Statutory Audit Department at Diwan P.N. Chopra and Company. Let's understand a common situation which arises in entities working in leasing business. Entity A leases out a building to Entity B for a certain amount and for a period of say 10 years, and subsequently Entity B leases out the same building for a period of 8 years to Entity C, along with all the risks and rewards associated with it. So, what will be the accounting treatment in the above scenario? Firstly, let's revise this scenario in two parts. Part 1, head lease, where Entity A leases out the building to Entity B. Part 2, subleases, where Entity B leases out the building to Entity C. Now, let's look first at the accounting treatment for Part 1, that is head lease. As per Para 61 of Ind AS 116, a lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to the ownership of an underlying asset. Further, as per Para 63, whether a lease is a finance lease or an operating lease depends on the substances of transaction rather than the form of the contract. However, certain situations that individually or in combination would normally lead to a lease being classified as a finance lease are: A. The lease transfers ownership of the underlying asset to the lessee by the end of the lease term. B. The lessee has the option to purchase the underlying asset at the price that is expected to be sufficiently lower than the fair value at the date of option becomes exercisable for it to be reasonably certain at the inception date, that is, the option will be exercised. C. The lease term is for the major part of the economic life of the underlying asset, even if the title is not transferred. D. At the inception date, the present value of the lease payments amount to at least substantially of the fair value of the underlying asset. And E. The underlying asset is of such a specified nature that only a lessee can use it without major modifications. If any of the above conditions are met, the lease will be classified as finance lease. Otherwise, the lease will be classified as operating lease. In our scenario, Entity A has an operating lease as it does not transfer all the risks and rewards of ownership of the building, and none of the above specified conditions are fulfilled. Accordingly, as per paras 81 to 86 of the Ind AS, Entity A shall recognize the income on straight line basis or another systematic basis. Now, for the lessee part, as per para 22 to 28 of the Ind AS, Entity B shall recognize a right of use asset and a lease liability and shall depreciate to ROU over its useful life and recognize the corresponding unwinding cost on the lease liability. Now let's understand the accounting treatment for part 2, that is sublease. Again, as per para 61 of the Ind AS, a lessor shall classify each of its leases as either an operating lease or a finance lease. In our scenario, for the sublease, Entity B transfers substantially all the risk and rewards incidental to the ownership of the building to Entity C. Furthermore, as specified under para B58, for determining the substantial period of lease, reference is to be taken from the life of RU asset rather than the economic life of the underlying asset. In our case, the head lease is for a period of 10 years and the sublease is for a period of 8 years. As a result, the lease term in the sublease covers the substantial life of the right of use asset arising from the head lease rather than the underlying asset. Since it meets the conditions specified under para 61 to 64 read along with para B58 of the Ind AS, and hence it would be classified as a finance lease. As per para 67 to 70 of Ind AS, the Entity B will recognize a lease receivable in the form of net investment in the lease on the date of inception, calculated at the present value of the future lease payments, and will de-recognize the corresponding RU asset created, and will recognize the difference between the carrying amount of the underlying asset and the finance lease receivable in the profit and loss. Further, as per para 75 to 78 of Ind AS, Entity B shall recognize finance income over the lease period based on a pattern reflecting a constant periodic return on the lessor's net investment in the lease. For Entity C, it will follow the same accounting applied by the Entity B in Part 1, that is, it will recognize a right of use asset and a lease liability and shall depreciate the ROU over its useful life and recognize the corresponding unwinding cost on lease liability. Thank you everyone for watching. I hope it has given you some valuable insights on sublease accounting, and if you found this video informative, please do like, share and subscribe.